dividend reinvestment, okay? And the reason is that instead of taking that money and getting taxed on it, you just tell your broker, hey, I want all that money to buy more shares. It's free shares.
Bear gang till I die, ho. Swooped up the homies and we about to start a sideshow.
A dividend is where a company says, hey, we're going to give you as a shareholder a share of the profit that we make. For some companies, for most companies, it's enticing you to hold their stock, right? Because the more you hold their stock, the more the value goes up. Because if everybody sells, the value goes down. So the more people hold their stock and leave it, the less likely it is to move down drastically. And the more likely there is a level of which they'll be buying off of rather than selling off of, okay? So what they say is hey, we're going to give you a portion of our revenue back outside of what the equity, the stock value is, okay? So every quarter, which is different than the earnings date, they're going to give you a percentage. I have MO. They give 8%. That means every quarter I get 2% of the value of every share back to me. So if the stock is $40, okay, I get 80 cents per share every quarter. Now you have three options. Well, two main options. Either you collect that dividend and pocket it, or you do what's called dividend reinvestment. And this is why I tell every single person, whether you're a dividend investor or not, set up a DRIP account. Dividend reinvestment, okay? And the reason is that instead of taking that money and getting taxed on it, you just tell your broker, hey, I want all that money to buy more shares. It's free shares. So like, for example, I had 200 shares of MO, and this quarter, they gave me 4 free shares. They gave me enough money that I got 4 free shares. So now I have 204 shares, even though I only bought 4, or I only bought 200. And next quarter, I'll get 4 more, and 4 more, and 4 more, right? So by the end of the year, I'll have 12 free shares. Well, guess what? The next divvy, they don't pay me just off the original 200. They pay me off the 212. So now these 12 free shares also give me free shares. And that compounds and compounds and compounds. And over time, you might have bought 200, and next thing you know, you have 500 shares. And each of those shares give you free shares. So now you're getting 10 free shares every 3 months. At $40 or $50, that's $500. Fuck it. We go again and buy more. You still get taxed. But I'm talking about you don't get taxed on that pullout. I would tell this to everybody, even if you don't know what you're doing. You're not a dividend investor. You don't know shit about that. I would automatically, just if it was me, I would go into my portfolio, go where it says dividends. Okay. Click on apply or activate, dividend reinvestments or DRIP. There's almost no reason why you wouldn't have that. Fuck it, buy free shares. Because what are you going to do with that 80 cents per share? Nothing. So if I could give one piece of opinion to everyone here, one of the best things you can do even if you've never invested in stocks, and you're like, shit, I found out about this stock thing that I had since I was a kid, and you're not planning on touching it, go in there and click on your DRIP. DRIP is good, but not in this market. There's always a chance to a dip to buy on. Well, that's what you use your extra capital for. We have a dividend investing channel in Discord if you guys want to go in there and look through it and see what people's I built for the first time in my life a strict section of my portfolio for dividend reinvestment after the dip in March. But I would say that there's almost no reason not to. I'll give you an example. There's somebody in this community I spoke to 2 months ago who their parents bought them when they were kids. Apple, Disney, and what was the other one? Shit. Fuck, I can't remember what it was. I think it was KO, right? In 2002, after the 2001 drop. Their parents never set up dividend reinvesting. What is this? 1.8%, but probably higher if you were in earlier. This is what, like 2%, and this is like 6%. If they had dividend reinvestment set up in that portfolio when the kid was born, and the kid's 18 or 19 now, it would probably have 8 to 9 times the value, potentially. But instead, they got a nice little check every 3 months. So your 10 Apple shares that you have at $4, right? You get 2%. So at $200, it's like, yay, I get $4 in my paycheck, or or I get $40 every 3 months in dividends. If they would have been reinvesting that when Apple was much cheaper, they would have 5 times as many shares. Disney, 4 times as many shares. KO, 7 times as many shares. Well, if they didn't allow partially shares, what you could always do back then, okay, is they would take whatever overages is and mail that out to you. Now, what I'm getting at is, forget this person. I'm saying if you're in a similar scenario, or you're setting up an investment account for your child or something like that, setting up dividend reinvestments is a super 5-head move. Luckily for them, Apple split twice. Think about splits and dividends. Think about getting a split and still getting dividends off the original value of those shares. Now you're triple dipping, okay? It's like a threesome that actually doesn't suck. Don't ask me.